Hello, everyone. Welcome to a live market update with Buying South Florida. We have a lot to talk about today, including the Voyager buyout. We have some FTX news. We're also going to talk about tax laws harvesting. It's about that time of year that a lot of that is happening. And I want to talk about how that can potentially affect your loan approval status. To do all that, I have a friend of mine, entrepreneur, and he has his own YouTube channel with it's called Time Freedom Daily. If you guys want to check him out, John Godshaw. So, John, thank you for coming on here with us today, man. I appreciate it. First, give us some news on the Voyager buyout and what that means to the investors in that
For sure.
company.
And got to be transparent here. I'm one of those guys that got my money stuck. So, when the FTX collapsed, they were the ones that were supposed to buy out Voyager's assets, and I believe they were supposed to reimburse all the people that had funds there. I want to say it was either like 70 or 75% of dollar for dollar. So it was a pretty solid deal. Thinking that they were going into bankruptcy and it could be lost forever. So that all fell through. And now Binance US has stepped up. And again, it's all, there's no real news right now, except the fact that this deal is taking place. I'm sure they're going to share more over the course of time about what that means to investors. But the bottom line is that the investors should get something back instead of losing everything, zero. Hopefully it's going to be something close to the FTX deal. If it's 50%, that's great. Again, talking about write-offs and stuff like that, on next year's taxes, whatever you've lost on that Voyager deal is tax deductible. So
Yep.
It's positive news. It's not exactly the best thing, but we all know that FTX really is under the course of all of this stuff that's going on in the last 6 to 8 months.
Yeah.
They've had their hand in everything, and it's all starting to kind of unfold and stuff like that. So look, it's positive news. I'm glad that people that have money on Voyager will potentially getting some back. A little bit of
And I think crypto's at a crossroads right now. This is officially the crypto winter that we were all expecting and kind of some of us prepared for, some of us didn't. But when you say the Voyager buyout, some people can get their money back. Remember, Voyager was a public company, so they were stock. That's where I got where I had most of my funds in Voyager, and that's where really I don't think I'm getting any of my stocks back. Essentially went to zero. When you say get some of the funds back, are you referring to just the crypto that's stuck in there, or
as far as I know, that's what was included. Again, I don't know if they're going to revalue the actual stock price, because again, they're in bankruptcy, so things they're not looking too good. And again, I don't know all the details on what the future holds on that respect, but yeah, we're talking about the platform, all the assets that were held, whether it is stocks, because again, Voyager allowed you to do multiple things, not just crypto. So,
right?
People that had cash actually were reimbursed, but people that had like USDC, which is a stable coin that's supposed to be a 1-for-1, is still stuck there, as well as all of the crypto assets and any other stocks you may have had. Now, again, I don't know how they treated the securities that you're holding on your platform. They may have been reimbursed, but again, if something goes to zero, there's really nothing to reimburse.
Exactly. The company essentially files bankrupt. I am not expecting to get any value back from the shares that I held or hold. But I didn't see anyone or any legal ramifications come out of the Voyager bankruptcy like we did with FTX. I know Bankman-Fried now is accepted, right? He's been extradited or in the process of being so. So what's going on with that side of?
So again, this guy, evil, just thief. I just don't get me started. He was pulled back. He had something happen in the Bahamas. They pulled him back into jail, but now he's already agreed to his extradition. The FBI is making, plans right now how they're going to bring him back over here to face charges. I want to say there's eight or nine different counts of types of fraud and wire fraud and all kinds of stuff that he's facing. And, he should be going to jail for a very, very, very long time. And they're also finding out that he's got property in accounts that are hidden from his personal bankruptcy, and they're starting to unravel that. So hopefully those dollars will be brought in to make people whole, or try to you get money back into people's hands that have lost money with FTX.
And the two individuals,
I got all my money for like 2 days before it all happened.
Yeah, thank God. I mean, the two individuals that on the sister company that were also involved have also pled guilty.
Yes.
So that I think everyone involved in that FTX scandal should go to jail. I think that cryptocurrency surviving, blockchain surviving this crypto winter, we're at a pivotal point right now, and
sure.
This needed to happen. Unfortunately, it happened to this extent, but something like this needed to happen so that we can know where the faults are, what needs and does it need regulation, what requirements need to be for deposits and so forth, which I think will only strengthen blockchain and crypto going forward into the future. And one of the things I've always liked about investing in real estate versus something like crypto, even though real estate has been around significantly longer, obviously, and it's something that you actually have a property, you have a tangible, like a real asset with you, right? If something were to happen to the market, everything crashes, everything goes to zero, you at the very least have a property that you're holding on to. That's always been my personal opinion over why I invest a little heavier in real estate over crypto and stocks and things like that. But needless to say, you should diversify. It is one of those fundamental things that everyone should do in their portfolio. It doesn't make sense to me to have all of my assets involved in real estate, and then if there's a market crash, I can't get access to those assets, right?
Right.
So as opposed to if you were to diversify, et cetera, and so forth. But nevertheless, I digress. The FTX scandal is definitely something that, man, it ruined a lot of retirement. It ruined a lot of lives savings. Many people that believed blindly in this man put all of their life savings into FTX and in crypto and so forth, and he essentially just stole it. He should go to jail the rest of his life, and it's an unfortunate situation for everyone that got caught up in that whirlwind. So and on the mortgage side, we can't take, or we haven't been able to take crypto as income to qualify someone, but we were loosening up the guidelines for accepting crypto assets to qualify whatever requirements for assets were for business purchases and so forth. So we're taking a step in the right direction, and then something like this happens. So now I don't know how well we're going to be, or how loose we're going to be with guidelines moving forward in terms of accepting crypto as assets required for buying properties and so forth. Which again, it kind of brings us to our next point here. It's tax loss harvesting season. This is where fund managers, retail, you and I look at our portfolio and we determine whether it makes sense for us to assume all of these losses, so that going into the next year we start fresh with our portfolio, rebalance a little bit, and maybe take some of the losses that we had this year as write-offs. So how does that work, or what's your strategy and so forth when it comes to crypto and stocks for tax loss harvesting?
Let's go into crypto first, just because I've done it more on the crypto side. The beauty about crypto and the asset is that there's no waiting period. You can literally get out of a position in crypto at a loss, if we're talking about tax loss harvesting, and immediately get back into that same asset with no waiting period. I know that with stocks, you are doing it towards the end of the year, but there's a waiting period. So you can't get into the same stock, or you can't get into the same group of stocks, a similar stock in the same industry for 30 days, if I'm not mistaken.
Correct.
So you can't wash your trades like you can in crypto. So it's much easier to capture losses in crypto, because most of the assets, depending on the market we're in, bull market, obviously your fees are greater, but in the bear market, your fees are less because there's not as much usage on the networks. So right now, as we're in the recession, let's call it a recession, whatever you want to call it, pullback, a slowdown, also being in a bear market, both stock market and also in crypto, everything's on sale. So, there's no reason why, and I do this, I'll go into my portfolio and say, okay, well, I'm down on this particular stock. And again, also remember, you utilize this principle if you need the write-offs, right? Because again, there's maximums you're allowed to have per year without having to roll them over, right? So make sure you need them. So if you don't need $20,000 in write-offs, you don't have to do it if you don't want to. If you want to hold your position, just be long in the position, that's fine. But last year I did need a lot of write-offs, and I did go in and literally I would go into that asset, I would sell it, and then I'd say, if I still believe in the project, even though it's down, I'd just go right back into it. But that loss is captured. Again, with the stock market, you'll have to capture that loss, right? As long as it's not in, you gotta make sure it's not in your Roth or your traditional IRA or your 401k. You can't capture losses there. These are strictly in your brokerage accounts, because everything else is tax deductible or tax deferred or tax free, depending on the vehicle that you're in with your retirement. And again, you just have to wait that 30 days before you get into that same asset and that same security, or the same market. Like, you can sell Amazon and then buy Walmart. That you just can't do that. That would be a wash, and that would be a taxable event, and you wouldn't be able to capture that loss.
Yeah, we can actually take a capital gains, stock dividends, etc., as income to qualify your purchase. So for someone that's income mostly comes from dividends paid, mostly comes from capital gains, that's definitely something to consider if you're in the market to buy a property this year or this coming year. Definitely take into account how much tax loss you're willing to take versus how much that's going to affect your qualifying income. As long as we can show a 24 month average of that income, we can assume that it's going to continue, and then therefore we can take an average of those 24 months as the qualifying income. So we can definitely take dividends, capital gains from the market, and so forth to qualify someone's purchase. So it's definitely worth having having your finances, your approval reviewed before you decide how much of this write-offs to take, right, on the tax harvesting, because it may prevent you from being able to qualify for a property. So where you gain some benefit in the write-offs, you may lose it where you can't now buy a property in this coming year.
Gotcha. Can I ask a follow-up question real quick? So when you're doing that with the dividends or capital gains income, and let's just say this particular year, this current year, you had $200,000, and the year before it was $1,000. Does that disqualify you from doing the average, or would that 200,000 turn into 100,000?
So it has to be something that makes sense, right? If you go up from 1,000 up to 200,000, it's what, like 200,000% increase or something like that. It has to be something that makes sense to underwriting. If you can show, if you're consistently being earning 100,000 in dividends paid, for example, and you go up 25% to 125,000, then that's something that makes sense. It's all within, usually guideline lives within that 25% increase or decrease percentage. Just like you can go up, you could also come down. If your income now drops 20 to 25% from the year prior, that may prevent you from qualifying for a mortgage using dividends pay or something like that. That also applies to business income. If you're self-employed, whether you take a pass-through Schedule K, K1, or if you do like C Corp or Schedule C, whatever, and your income drops 20 to 25% from the previous year, that may raise some red flags in underwriting, and now you may have to show additional proof that your business is in good standings, you're still in business, you're making equal or the same that you did last year. So it's definitely something to consider. And I wanted to add additionally, if someone doesn't qualify for, let's say you want to buy an investment property, and now you don't qualify because you had a huge tax loss, write-off. Let's say your business now went down more than 20-25%, and you can't really show that your business has improved. You're essentially on a downtrend. There are other assets that's coming in and so forth, but you still can't show that on your tax returns, not yet at least. We have alternative lending options for business purpose loans or for investment purchase of properties. we can actually qualify someone with 25%, at least 680 credit score. So 25% down, 680 credit score, investment purchase, and we can take the rental income of that property. As long as that rental income offsets the mortgage payment, you qualify for a purchase. Again, it's something that, it needs to be talked about with your financial advisor, your CPA, your mortgage broker, and to kind of just lay out the strategy for the coming year. If you're planning on buying an investment property next year, then maybe it will make sense to take some tax loss harvesting on your tax returns, maybe some additional write-offs that you're eligible for, knowing that you have access to a business purpose loan and investment property loan that you're not going to need to show your tax returns or prove any income, because you can essentially just 25% down, 680 credit score, and you qualify for that mortgage. So definitely something to keep in mind there.
Where do the rates change, basically, going for your second home or whatever, and then you're going to what's the fluctuation in rates there?
So rule of thumb is always the more you show and the more you can evidence, or the bank can evidence, tax returns, pay stubs, W-2s, verification of employment, etc. The more you can show, the lower the risk for the bank, therefore the lower the interest rate. So there's always a limit or a floor to how low the interest rate can be. So let's just say market bottom, right? The lowest possible rate you can get on a 30-year mortgage would be an FHA or a conventional mortgage that requires tax returns, W-2s, verification of income, and also the veterans loan, the VA loan, right? That requires verification of income. From there, the next step up is, doing something like a business bank statement loan, where we ask you for 12 months bank statements. We take all of the business deposits, create a qualifying income from those deposits, and now you don't have to show tax returns. We qualify you based on your business deposits. That's kind of like the next tier up.
Sure.
From there, because now you're evidencing your income. You show that your business is active, you have deposits, etc., with bank statements. So that program tends to be about 1% higher than your market bottom, your best possible rate, right? You're still showing something to satisfy the income requirement. The step up from that one is something like an investment property purchase, like a business loan or business purpose loan, or we call those debt service ratio loans or no income ratio loans, right? Where you're essentially not showing any income. You're not showing any evidence of income, none of that. We're essentially just taking either the rental property income to qualify the purchase, or we're just taking someone's, good faith saying, this is how much I make, and there is no evidence from that.
Gotcha.
That requires a higher down payment, requires good credit, something that, quick note, didn't happen back in 2008. So higher down payment, higher credit requirements, and the interest rate tends to be about 2 to 3% higher than whatever the market bottom rate is, right? So you see a little bit of a different, and then the very highest tier is something like private loans. This is, individuals like you and I lending out money.
Sure. Hard money.
Investment property for investors. Those tend to be 4 to 5%. They tend to be, shorter terms, typically 12 to 24 months, something like that. So at the very bottom of the market, the best possible rates, you have everything that verifies income: FHA, VA, conventional, etc. You could also include conventional investment purchases in that tier, right? And then from there on out, you have the next level, which is bank statement loans, etc. And then you have no income verification. Then you have private loans. That whole range typically is from 1% all the way up to 4 or 5%, and it really depends, right?
Sure, excellent.
So it's definitely worth, one of the conversations that we have with our clients in detail is, should I take more deductions that I'm eligible for? Should I do this tax loss harvesting, et cetera, knowing that I'm going to be buying a property next year? And it's a very important conversation to have around this time of year. So I encourage anyone that is or will be in the market to buy a property this coming year, have that conversation before you make any decisions, because it can really affect your plans to buy a property going forward.
Gotcha. And again, just to talk on, it's not called tax deduction, but it income deduction, is make sure that if you have the extra funds there, right, you're maxing out your your IRAs, you're maxing out your SEP IRAs, you're maxing out your Roth IRAs. Those contributions, whether you're maxing out at 6,000, whatever your max out is, that comes right off of your taxable income. So another thing to think about this time of the year.
Exactly. And there is a big difference between reporting, deductions like, your expenses, for example, versus your deducting or lowering your taxable amount. Your taxable amount, things like maxing out your SEP, your Roth IRAs, etc., do not affect your qualifying income, but it does affect how much taxes you're paying to the government. So there's a big difference there between expenses deductions versus qualifying or qualified investments for income purposes, right? So definitely keep an eye out on that. John, anything else you want to add on there, man, before we get off? I think we
Merry Christmas, everybody out there. Happy holidays.
Happy holidays. Absolutely. We covered the Voyager buyout, FTX fiasco and all of that. Talked about some tax loss harvesting, some strategies going forward. Definitely have a talk with your financial advisor, your mortgage broker, before making any decisions on your taxes. And we do have many different loan products for the investor, first time, second time home buyer. So definitely give us an opportunity there if it comes across. Other than that, guys, happy holidays. Thank you for your time. And I hope this has been useful. Be safe. Stay safe.